Hi, I'm Audie, and today we are untangling a very hot topic in the financial world, the S&P 500 at 8,000. Untangling Tom Lee's 2026 forecasts. We are going to build a clear roadmap of the short-term rallies, the looming corrections, and the ultimate destinations for the market. Let's jump right in and see what all these massive numbers actually mean for the future. Right now, you are probably seeing headlines everywhere that tout S&P 8,000. But they consistently fail to specify the timeline or the exact conditions required to get there. To clear up this total confusion, we need to recognize that strategist Tom Lee is actually outlining three distinct scenarios for 2026. These three unique paths are what he calls the August call, the year-end base, and the bullish upside. Looking at that first forecast, which is the August milestone, hitting that big target might seem like a massive leap, but it's closer than you think. Reaching between 7,900 and 8,000 this month requires only a modest 3.6% climb from the pre-forecast close of 7,723.55. So, the math for this short-term jump is actually quite doable. So, what exactly is the fuel for this short-term rally? There are three fundamental drivers supporting the case for an immediate chase higher. Pillar 1 is deleveraging, where cash sitting on the sidelines forces a chase higher as fear recedes in the market. Pillar 2 is corporate earnings, as Q3 earnings have been beating estimates by over $15, and 2027 expectations are rising. Finally, Pillar 3 is AI investment, because the capital spending cycle remains unbroken despite some noted weakness in the semiconductor and DRAM sectors. Diving deeper into that first pillar, we encounter the deleveraging paradox, where fear actually acts as fuel. Recent market consolidation caused investors to get cautious, reduce their exposure, and move their money into cash. However, if the market fundamentals hold strong, all that sidelined cash becomes the exact fuel needed to force a rapid chase back into equities, creating heavy FOMO, or the fear of missing out, and driving the chase higher. If this rally kicks off, who exactly leads the vanguard? The push to 8,000 won't be uniform across the entire stock market. Instead, Lee identifies three highly correlated risk-on proxies that will strengthen together if investor appetite returns. This charge will be led by the Magnificent Seven tech giants, software stocks, and Ethereum, which acts as a major indicator for risk-on behavior. But hold on tight, because here is the plot twist. A rally to 8,000 does not mean the market just goes straight up. Lee warns that a severe correction is looming before the year is over, driven by tech-heavy volatility. Investors need to be cautious because a meaningful 10 to 20% correction zone is ahead. Assuming we survive those bumps, how does the valuation engine reach a much higher target of 8,800? Reaching this ultimate bullish scenario isn't actually about companies having higher earnings. It is about the premium investors are willing to pay for those earnings. Even with a static base of $400 in earnings, expanding the PE multiple from 20x to between 21x and 22x is what ultimately pushes the market from 8,000 up into the 8,400 to 8,800 range. To keep all these numbers and theories straight, let's look at the 2026 target matrix, which separates Tom Lee's individual calls by their timeline, target, and primary driver. Scenario A targets 7,900 to 8,000 by the end of August, driven by sideline cash chasing a deleveraged market. Scenario B aims for roughly 8,000 by December 31st, 2026, fueled by sustained earnings and unbroken AI spending. Lastly, Scenario C looks at 8,400 to 8,800 by December 31st, 2026, which assumes earnings remain at $400, but PE multiples expand to 21 to 22x. When you put all of this together into an integrated roadmap, you can see exactly how a bullish market can still experience extreme volatility. The sequence starts with point A, the August rally hitting 7,900 to 8,000. This is eventually followed by point B, which is a meaningful 10 to 20% correction. Finally, we reach point C, where the dust settles and the bull resumes its climb past 8,000. This brings us to a major fork in the road and the big question for the fourth quarter. Because we are close enough to 8,000 right now, the final number is actually less important than the sequence of events it takes to get there. From the current market, one path hits 8,000 in August. derails into an early correction, and recovers slowly. Alternatively, the market might fail near 8,000 now, dip into an early correction immediately, and then surge aggressively to 8,000 or more by year-end. Ultimately, everything we've talked about today is a conversation about the destination versus the path. The long-term bull case remains completely intact, but the path forward could be extremely volatile. Tom Lee's outlook is not a straight line up. Instead, it is a realistic forecast of ultimate growth that requires investors to have the stomach to survive violent, tech-heavy corrections along the way. Thank you all for watching, and we will see you in the next video. Investing in options trading involves significant risk and are not suitable for all investors. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.